Waf Hamad, CEO of UBS, welcome to Bloomberg. The deal, the reveal and the buyback is today in my mind. Let's start with the buyback. Sizable and a very strong message to the market. $5 billion for this year. Talk me through the message to the market on the buyback.
Well, what's important here is that we have ended the year in a very good way with a core tier 1 ratio of 15%. We have a model that keeps generating capital. Our growth is capital light. We don't need a lot of capital to grow. We want to keep a strong balance sheet. However, we do have surplus capital. If you have surplus capital, it doesn't need to be used for further growth, then you should redistribute it to your shareholders. And that's why the message is there today.
Progressive is the word that's used around the dividend and payout. In terms of how the market sees you, are you trying to push out ahead as the payout bank of choice?
Not necessarily. I think what we are looking at is literally our strategy. So the market was waiting for, okay, where's the strategy going? Our strategy is to build that global ecosystem for investing. Now, building that ecosystem with our clients, with new contributors, does not need a lot of capital to grow. We grow it. It will grow in income. It will need some capital. It generates a lot of capital. Now, if it generates a lot of capital and it grows, you can do two things. You can continue to pay a handsome dividend and redistribute to your shareholders if you have a capital surplus situation. And that's what we do.
You've taken an additional provision on the French litigation, perhaps higher than the market had assumed. But does that free you up? Does that remove a cloud? Nearly $1 billion of provision for the French litigation. Does that free you with a message on payout?
Clearly, you know, the reason why we took the provision is because we felt that we needed to take the provision, right? So we are in appeal, we're looking at the different avenues, but nevertheless, we think that the best estimate for a payout here under that case is the 1.1 billion. Therefore, we took a higher provisioning. It does de-risk.
Yeah.
It does de-risk, and with that, it gives more freedom to continue to do payouts.
You've got the reveal, the targets. There's lots of them, but I want to focus on two, which is the profitability target and the cost to income. Now, they're underwhelming, 15 to 17%. I thought we were going to get something much more demonstrative, and I thought we would get a much more aggressive cost to income ratio. Are these safe ratios to give the market?
They are ratios that we feel that if you run different scenarios as to where you think the future will go, we will be able to make them. So you can't just take the upside scenario, the most optimistic scenario, and say, well, that's the one we're going to hit. We're realistic here, and we have a realistic relationship with our shareholders. So clearly, if we can further improve our returns, we will always further improve our returns. We closed the year at 17.5% return on CET1, which is already in that range. I do realize that.
That's why I would have thought it would be more ambitious.
But let's just work on our story going forward. It's that for the next 3 years, there may be different scenarios. As you know, there's quite some tension in the market. Inflation is looming, and that may also kind of have impact on us delivering these targets. Now, therefore, the ranges, what they are, it is already a step up from the range that we had. We had a return range from 12 to 15. Now we moved from 15 to 18. On the cost-income ratio, we really step up. It was 75 to 78. We're actually going down from to 70 to 73. So I do think there is quite some ambition there. It is reflective of the plan that we have put in place. And clearly, if we can produce better, we will always do better.
Okay. You talked about the start of the year. For a lot of people viewing Bloomberg, it's been a brutal start to the year in terms of risk, in terms of volatility. How has that transferred to client activity in this month?
Actually, it's different depending on the clients you're talking to. So, as you know, and as the market is used to, we do our investor survey every year. And we do see that investors are a little bit fearing the inflation, they're fearing COVID and how it will end, they're fearing some geopolitical tension. Having said that, they are still relatively optimistic. So they have money sidelined to come back into the market. And for example, in Asia, that can happen very quickly. However, if you look at January, we do see a bit of lower transaction activity in Asia particularly.
Okay.
However, globally, on the institutional side, we actually saw a lot of activity because the institutional side is basically rotating their portfolios in order to be ready for a year, which could be for which they may have to position themselves a little bit more defensive there as well, looking for different asset classes. But that rotation itself actually generated a lot of activities through our ecosystem.
Do they fear inflation the most?
I think the fear is really the geopolitical fear, because that is something that is difficult to kind of tackle. It's more event-like. Inflation is one that, in the end, you take a view and you hedge your bet on it. For us, for example, on the inflation side, it will generate higher interest rates, therefore a tailwind in terms of interest income. It will have the market look for alternative propositions, which we are the best place in the world to look for, because we have the combination of the clients and the providers for the alternative market space. But, for example, it will impact our costs as well then. So everybody's making their own analysis if it comes to inflation there. But you can work with that. Geopolitical tension and the potential events coming from it, that's more difficult.
That's much more difficult to deal with. Let's just square off a few issues. Asia seems to be a focus of where there's been a little bit of a drawdown. Any material deleveraging or a reduction in lending? Because that's a critical part of the wealth business.
Yeah, in the fourth quarter, we actually still saw lending growth in the wealth business as well, at $3.9 billion. We did see further deleveraging in Asia there. However, it did not hamper our inflows in net new fee-generating assets in Asia. So on one side, you see in Asia some deleveraging, so basically taking some risk off the table. On the other side, if it comes to the mandates business for us, new inflows coming through in wealth management in UBS. So it's a testimony to the strength of our brand and franchise in Asia.
Inflation is very real for everybody. You've identified that. The Fed has got to fight that. The market says 4 or 5 rate hikes. What do you believe they will do? What do you believe the market can take in terms of rate hikes without a major implosion?
It's exactly that number, I think. So otherwise the market wouldn't be expecting it, right? It's almost kind of a logic reasoning in itself. But I actually think it's about,
So just to be clear, you're going for 5 to 7?
Sorry?
You're going for 5 to 7 rate hikes?
No. It's the 4 to 5.
4 to 5.
That is exactly what is priced in the market as we speak. And I think the market can take that. And I think the Fed is just waiting for the market to have really assumed and absorbed that, and then they may do it, or they will do it. So basically they are signaling it will be coming, the market is adjusting, and then they will do it. And clearly maybe towards the end of the year, depending on how the inflation actually develops, they may either do more or less. From an inflation perspective, I actually think 2020 will be a year of 2 halves. In the first half year, still high inflation, but because of then hopefully decreasing tension in the supply chain, decreasing tension in the labor markets, and a more balance between the demand coming from COVID savings, for example, that from that perspective, hopefully also supported with some monetary policy there, that the inflation will be down and under control towards the end of the year. So I think it's going to be a year of 2 halves here.
Okay, let's see how that plays out. But inflation plays out in wages. Christian Saving is seeing an increasing war for talent. Are you?
I think we're all in the same market here, right? So where we see some pressure on our workforce, we see it in the US. We see it a bit in wealth, Asia Pacific, because we are the leading wealth manager in Asia. And we see it in investment banking across the globe, in the banking sphere. Now, clearly, we pay competitively, we pay for performance, we have the talent to make our plan, and to the extent we need to pay up, we will do so, as we have done so last year. Having said that, we have a very good and attractive culture to work in as well. So I think there's more recipes than just pay to make sure that the people stay.
But if I look at the bonus pools around the world, Deutsche Bank up 15%, Goldman's, JP Morgan, 40 to 50% up. What kind of percentage do you see the bonus pool at UBS rising this year?
I can't give the percentage yet, but it is increasing.
Well, 2020 was up by 24%.
Yeah, it is not as much as that this year. It is about paying for performance. That is what is important. And if people perform, they get paid well. If they don't, they don't. Now, clearly, the market has done really well. We have done really well in the market, so the pay is up.
Are you paying to hire? I'm thinking in wealth, the sign-ons in investment banking and in wealth management. I'm just curious, are you paying more to bring in? Is that where the pressure is versus retention?
We are looking at retention here.
That's where the real hotspot is for you. You've just done your first major signature deal, $1.4 billion for Wealthfront. How big can you make Wealthfront in the United States of America?
It's not only about Wealthfront. As I already kind of indicated in the second and third quarter strategy update, we were looking for a digitally led value proposition in the US. This one fits perfectly well there. It's a proven model, and we can build it out to deliver more value propositions. So it can be big as Wealthfront, but also for Wealthfront to develop some additional value propositions that we agree with them they could, with their engineering culture, develop.
Are you actively looking for other acquisitions in Europe and Asia in that robo space?
Not necessarily. Our acquisitions should be bolt-on acquisitions. They should really accelerate our strategy. We are coming with a plan that is generally based on organic growth. But clearly, if there is an acquisition opportunity as a bolt-on in capabilities or scale or technology, we will certainly consider it.
Ralph Hamers, CEO of UBS, thanks for welcoming us to Zurich.
Good to see you again.